Hello, everyone. Welcome back to the Brick and Mortar podcast by Hubexo. I'm your host, Shanice. Our next guest has a track record that includes managing $250 million in project costs to achieve over $1 billion in gross sales. Gedeon is a managing partner at Gedeon Financial and an innovative fractional CFO and real estate development professional with 15 plus years of experience in business finance and property development. He has helped companies overcome challenges in capital raising, financial forecasting, and bringing ambitious real estate projects to life. If you want more episodes like this, don't forget to like and subscribe. Let's get started. Hi, Evans. Thank you so much for joining us today.
Thanks for having me, Shanice. I'm happy to be here today.
So, you're a fractional CFO and real estate development advisor. For those who don't know what that is, what do you do?
I'm glad that you asked that. There's two facets for my business. There's the fractional CFO services side of the business, which that is exactly what the name implies. It's being a part-time CFO for a mid-sized company. Oftentimes, you have mid-sized companies that want to bring on someone with technical experience in the finance space to help them do their financial planning and forecasting. So that's a service that we offer. And it could be done on a part-time basis versus bringing someone on staff full-time, in which that's going to overburden their overhead, which is something they don't want to do. And then the other aspect of our business is we are real estate development advisors. So we go in and help family offices execute their acquisitions and development of commercial multifamily assets, and which will help them design the project, will help them do the coordination with the projects, everything from the acquisitions, which oftentimes involves face-to-face with your politicians and your legal counsel and dealing with the architects and engineering. And then ultimately, we would help the family offices or our clients get to a point they get through the entitlement, design the projects, then we help them price the projects, and then ultimately get it through a point where it's leased up and ultimately sold. So just think of us as your in-house developers, the other side of our business that we offer.
Nice. That's such a
Yeah.
necessary service.
Yeah.
When is usually the best time for developers or your clients to bring in a fractional CFO or real estate development advisor?
I feel oftentimes where we're getting a lot of our clients calling us is when they've hit the peak. They have a lot of deal flow. They have a lot of things in constructions or pre-construction, and they're just trying to figure out, how do I maneuver through these projects? What do I do next? And how do I also make sure my business is fundamentally sound? And so we are in great demand for a lot of mid-sized companies because they don't want to take on all this business and then financially hurt their business. So we can come in at any time, but I find that a lot of our clients bring us in when they're just trying to strategically solve a problem financially or design wise. And they said, hey, I just need this person for, half the year or on a part-time basis to help me figure out these challenges as I'm growing as a business. So there is no exact time that I would say that our client can engage us, but I find often when they just need someone that understands stuff operationally and from a strategic standpoint is when they call us in and we assist. And some projects we've come in the beginning, others we've been in the middle, and some towards the end. So it really depends on the client.
That makes sense. So you mostly work with multifamily assets. In what capacity do you do that?
And so that is the asset that we've been working with most recently. I actually have a 200 unit deal that I'm getting financing for in Miami. I came up with a business plan and helped the client.
Congratulations.
Thank you so much. I helped the client source the capital. And so not only did I come up with the business plan and help source the capital, but ultimately came in at a point where they need to close. And so we were very thankful in the sense that we could come in. That's actually a build to rent project, not necessarily multifamily. So the build to rent is just townhomes for rent. And so that's where we're helping this particular client. Another deal that I was working on happened to be multifamily. We went after a city-owned project, and I had a family office reach out to me and ask me to help facilitate the political process and putting together the business plan. And so I was able to do that for that particular client. So it's something that we've seen recently, but it's not just multifamily. We also have experience in office and industrial and retail as well. And just broadly speaking, we're able to come in and help our clients think through the financing piece of things, as well as the design piece of things. And then ultimately, when they want to sell, we're there for that services as well.
Nice. How have you seen the financial landscape change in the past couple of years?
It's been very interesting. I think the biggest thing is it took a while for interest rates to go down, and we've seen a few meetings with the Federal Reserve and them reducing the rates, which is going to help deals pencil. And the other thing that we've seen, which a lot of people didn't anticipate, was we saw increases in our operating expenses. And that's particularly in South Florida, we have insurance and we have real estate taxes that have gone up. And it's it went up to a point that a lot of deals didn't make sense. And thankfully for us in Florida, where we have politicians in place that are working around the clock to help us solve some of these increase in expenses and costs, which were hard to predict. And I'm sure a lot of people did not have enough cushion in their underwriting for it. So those have been the biggest things. But rates are starting to come down. We heard the Federal Reserve says we can anticipate some more rate drops with inflation not going up. So that will help, but just the increase in rates and uh, insurance costs and real estate tax, at least in Florida, has been some of the biggest changes we've seen.
Hmm, that's interesting. So with
Yeah.
this interest rate volatility, since it's still affecting the market, how are you advising your clients to layer their capital stack?
Right now, I think the answer is in financial engineering. It's really identifying areas where you can go talk to various consultants and see if they can help reduce on the insurance and taxes. So there's brokers that are out there that are fighting to get you the best price and making sure you have the best coverage. So that's one area. And the biggest area where it's hurting the financial projections. The other is actually going to your local municipalities and seeing what they can structure for your projects. And I know there is a going theme, not just in Florida, but across the nation, in which, the very people that are servicing our community are having a very difficult time affording to stay in the very communities that they service. And so the city is eager to put out what is referred to as workforce housing for your teachers, your police officers, and your firefighters. And with the developer putting out that business plan, there are incentives that the city or county can give you, or even the state even, to help you fulfill those plans. And that's where I'm seeing the most opportunities is in getting subsidies at the city, county, or state level to execute the business plan.
Wow, the workforce housing situation is so terrible. How are you helping developers see the benefit of workforce apartments without compromising on the returns they expect?
And that goes back to the financial engineering. The capital markets want what the capital markets want and what they want to solve for, and that makes a lot of sense because a lot of these institutional investors are there's fiduciary responsibilities that they obtain a certain return, and so with that, they still have to get their 2x on an equity or two times their equity, or they have to get, their 18% on their interest on the capital they put out because that's just how they were structured. And so it's really hard for, in a lot of instances, for them to pivot unless they have a clause to do so. And so you solve for the other things. You solve for the expenses, the costs you saw for cities giving you monies, especially if they're catering to the people within the communities that need to stay in the community to make it better for the community. And so that's where a lot of developers and clients in particularly love this business plan because they say, hey, I still can solve for the investor returns by way of um, getting some subsidies, and I may or may not make as much profit, but the deal still works where I'm willing to move forward and have something to do versus do nothing, which is the alternative for a lot of family offices and clients.
Yeah. Why do you think workforce housing is so difficult to make financially viable?
I think it's really a matter of where people want to spend their time and resources versus it's unable to be done. We have some clients of mine that have successfully done it by asking for a reduction in taxes, and they've asked for other subsidies, or cities just gave it to them because they wanted the projects. And so a lot of times where developers do not want to entertain this business plan is because there's typically something that comes with it. You have to keep your rents at a certain level. You have to, make it so X percentage of people could live in your community. And so that doesn't give the business plan the free market, which if you're doing market rate apartments, that's generally what you're doing is you're catering to the market, right? And so when you bring in these subsidies and these cities give it to you or the counties give it to you, typically they say, hey, you're in this box per se, and you can't color outside of this box, and that creates a situation a lot of people don't want to be in, particularly people in capital markets. So I think it's just the administrative load is why it's not as compelling. But in today's environment where deals are becoming more difficult to execute on because of costs increase and expenses increase, and it's becoming more and more popular, and people, developers and clients in particular, are more receptive to the business plan because they say, hey, this is an opportunity where we can leverage our platform to actually execute on deals because what we were doing in the past is not working today. And so that's where I'm starting to see some interest in this space.
Yeah, you mentioned capital and the cost increasing. So I realized that capital has become increasingly selective. What are the biggest financing constraints that you're seeing?
I think the constraint is really the returns, right? Because that's not changing. The investors still want their returns. The rich guys still want their money on their interests, and so that's not changing. And so that is the constraint, and to solve for it is, as I stated previously, is looking for different subsidies and really looking at your numbers to ensure that you are getting the uh, numbers that you need to get in order to make the deals work. And so it's a bit of a financial engineering and a lot of moving parts, but you can definitely get to where you want to go if you spend the time doing it. And that's what I'm here for, is to help you or my clients in particular navigate the different subsidies and run the numbers on it to see where it makes sense for them in terms of the projects they pursue.
That makes sense. So most investors have a specific metric they look at to validate a deal. What's the number one data point that usually gets investors to commit to long-term redevelopment projects?
That's a really good question. I think one of the most common theme I have seen throughout the course of my career and working on both the uh, banking side of the business and as a contractor and developer before started my consulting company full time is the trend of having that particular project in a great location. A lot of institutions refer to it as a core market, is something that everybody is always excited about doing. So, when your project is in Miami and it's near Wynwood or Little River or some of these dense area, then there's a lot of things. There's better resources to the number of subcontractors and vendors. There it's just dense where for the capital markets, they like it because absorption shouldn't be a problem. So leasing up your buildings shouldn't be a problem. And so that's one common theme I have seen in the various businesses I've consulted for or worked for, is that they all like the core market. And with the core market, it brings a lot of positive things. It's changing a little bit. I think in some areas, you're starting to see some people say, hey, it's too expensive to live here, and we're going to kind of go a little bit north, or we're going to go a little bit south. But no matter what, when things get better, you'll see this migration back to the core markets. And I think that's one thing that across the board, bankers, developers, and contractors all love when it's a deal in the core market. Like it's in an area where there's a lot of action.
Yeah. So as a fractional CFO, you're often brought onto deals to create value quickly. How are you incorporating data intelligence platforms to create value for your clients?
Both as fractional CFO and real estate development advisor, those two functions are critical and for a lot of my clients and family offices. And what I have discovered is, in order to ensure that I deliver the best service for them, I have to rely on a lot of data and technology. So one of the more frequent ones that I use is CoStar. That gives me a lot of market intel. And then there's Strategy Matrix that also gives me a lot of market intel as well. And so, and Real Page. And so there's a number of tools that I use to get a gauge of the market. And on the contractor side, there's also tools as well. So it's very imperative that I'm constantly using these tools because they're giving me the market insight, not only on the micro level, but also on the macro level. So I'm getting an idea of what's going on in my immediate market and then globally as well. Am I being impacted by what's going on just in Florida, or is it also happening around the US? And how do I position myself not to get hurt? And that's the type of research that I'm doing so I can also advise my clients as they're working through their projects.
Nice. So I want to touch on the amount of loans that were originated in 2020. A lot of them are maturing right now. Have you been seeing deals die completely, or have they been restructured to survive?
That's very interesting. What I am seeing in the market these days, which I find compelling as well, is the loans that are maturing and someone that overpaid for it are, in a lot of instances, being bought below replacement costs. And so
Mm.
that's one thing that I'm seeing. And so if you don't like taking on construction risk and you want to get the deal at a good basis, there are opportunities because a lot of people bought wrong. Um, but if they bought right, then it's just a management situation. How do I keep my capital improvements low, um, and defer them until the markets get better and I can refinance or sell? How do I keep my expenses low, i.e., insurance, real estate taxes, so that I can get cash flow to my investors? So those are the things that you have to be thinking about in today's environment because every dollar counts. And if you bought wrong, there's very little you can do to pivot, and hopefully there's a buyer on the other end, and hopefully your investors can be whole. But I am seeing a lot of deals, particularly the ones that were delivered in 2020 or has maturity in 2020, and you know the if they bought wrong, they're basically getting bought back from a new investor at replacement cost or a better basis than the previous owner. So a lot of that
Mm.
going on all go,
That's so interesting.
going on. Yeah.
What are some creative ways that you're seeing clients structure new deals to keep their return on investment attractive?
I see clients doing a number of things. One of the things that I'm working on with one of my clients is to structure seller financing. It's not something that is very popular when things are hot, but in today's environment where sellers really do need to sell for whatever reason, they're receptive to options. And so I am working with a client right now. We're actually going to see a property tomorrow, and we're proposing that. And so there's opportunities in that. And, capital markets are still solving for capital markets. That's not changing, at least anytime soon. So we're looking at angles for other clients where we can take advantage of subsidies. That's reduction in impact fees if we're building or building permit fees or even reduction in taxes at the state and the local level. And then there's some pretty cool financing that's out there. A lot of cities and counties are coming out and doing bond programs where the cost of capital is lower and makes it uh, easier to do deals. And so we're seeing a lot of that as well.
Wow, that's so incredible. This has been a really incredible conversation. It's been so valuable. I know that our viewers are going to get so much out of it. So thank you, Evans. How
Thank
can
you.
people get in contact with you?
I would say the best way is via email. I'm always checking my emails when I have opportunities. So you can reach me at evans at gideonfinancial.com. The other way is we check my business line as well. So my business number is 561 203-9724. And then I'm also on different social media platforms. Everything is at Gedeon Financial. So that's for Instagram and Facebook, as well as LinkedIn at Gedeon Financial.
Perfect. Thank you so much for joining us today.
Thank you for having me. Greatly appreciate it.